So I'm Paul Blakeley and CEO at Jadestone. I'm going to just spend a few minutes talking about our business. And for those that aren't familiar with the oil and gas business, of course, it's a commodity, it's very cyclical, and like so much of industry, suffered very significantly last year as a result of the COVID pandemic. In fact, in April of last year, Brent oil prices dipped below $20 a barrel, which is about as bad a cycle as I can remember. And to some extent, as I describe Jadestone's story, just summarizing last year is important because it sets the scene for how we positioned ourselves for 2021. Jadestone operates oil and gas properties in Asia Pacific. We've been building a portfolio since we started the business in 2016. I'm just going to start with an overview of our business today. And I'll just see if we can get that going. That should be slide 3. And what that really summarizes is the business today. We produced we're producing around 13,000 barrels a day of oil equivalent from producing assets in Australia. We work pretty hard in our business on maintaining safe operations. We had no incidents or injuries during the course of last year. At a time when industry was reducing dividends, we introduced a maiden dividend for the company, which was a pretty important milestone as a demonstration of strength in the business. We also acquired new assets last year, which I'll touch on, to provide inorganic growth for the future. And of course, as we look at 2021, I'll describe something about further growth from the organic business within the portfolio. The balance sheet is really strong. When we listed in London in 2018 on the back of an acquisition of an oil asset in Australia called Montara, we took out $120 million reserve-based loan. We've been paying that down, and even during the course of last year, as oil prices were low and cash flows were constrained, we paid off over $40 million of that debt, so that we ended the year 2020 with a doubling of our net cash position from $39 million US dollars to $82 million, and paid off, as I say, the bulk of the debt. The final installment of $7 million was made at the end of March this year, and so as a company we sit here today with a lot of cash on hand, zero debt, and looking at further growth opportunities. So I'm going to move on to slide 4. I hope that's coming up. As a part of our business, of course, and what's increasingly setting the tone across industry is a focus on ESG highlights. And for us, this is really important. What we tend to concentrate on a number of key measures. The first one is around what we call target zero incidents, zero environmental events, zero spills, those sorts of things. This is really important for the oil and gas sector, and we achieved many of those objectives. if we think about the business too, I'll just select a few highlights during the year. With zero incidents, we also set significant environmental improvement actions looking to reduce emissions by 10%, which we achieved, which is all around also reducing waste and reducing discharges, and really reducing our footprint, our environmental footprint is a key measure. And of course, as our strategy is largely around acquiring producing assets from other companies, the principle for us is we're not building new facilities, we're not exploring in greenfield locations. And so if you think about sustainability, what we do really is to make sure that we maximize the recovery from what's already there. And as a contribution to a sustainable world, we think that makes sense. Also on ESG, I mean, we met objectives in recruitment of local nationals, provide jobs to young talented people in the countries where we operate, which is Malaysia, Indonesia, Vietnam, as well as Australia. And we're looking at gas developments in these countries, which otherwise might be coal-fired power stations to provide energy to local communities. So, in that context, we think what we do is important and directionally what these countries actually need. Moving to slide 5, I just show a map which sets out the footprint of the company, as I've touched on. In 2016, our first acquisition was the Stag field offshore Australia, produces around 3,000 barrels of oil today. We acquired what you can see in Indonesia is the Ogan Komering asset. And then in 2018, with our London listing, it was Montara. 2019, we announced the acquisition of Maari in New Zealand, producing asset, about another 3,500 barrels net to Jadestone. And then last year, we closed the undeveloped Lemang acquisition in Indonesia, ready to develop gas field. As I touched on earlier, it's gas for local markets, really important. And we announced just a month ago the acquisition of 4 producing assets offshore Malaysia from Sapura OMV. So the business is growing quite strongly. And I think the best way to describe that is looking at slide 6, picking up the growth story. And in 2020, with the COVID pandemic raging, we made a decision to pull back on capital spend. We had allocated 160 million of development spend in the year, and in the end we only spent 24, deciding that the most important thing to do was preserve the balance sheet, which we did. And so what we're doing right now is really picking up, as oil prices recover, we're picking up that capital investment now. And so what the chart here on slide 6 shows is low and flat production through the second half of last year and into the first half of this, because activity in our business takes time to re-engage. We have a drilling rig starting in June, and we'll drill a development well at Montara, and then we'll carry out 2 what we call workovers on subsea wells in the Skewer fields close to Montara. And so what you see on the chart here in some of the colors is some pretty strong growth in production from those activities, from H6 first in the pale blue color towards the right hand side of the chart, and then the deeper blue, which is the 2 Skewer wells. And then overlaying in orange is the Maari acquisition, which we hope will close. It's going to add around 3 to 3,500 barrels a day net to Jadestone, and the chart doesn't show the Malaysia acquisition, which is another 6,000 on top. So So what that shows is really reinstating strong growth through the second half of this year and into 2022. And with all of these projects working, we'll more than double our production year on year. And then just to describe a little bit some of these more recent acquisitions to give you a sense of what the business is about. When we buy producing assets from the majors or from other companies, and on slide 7 we're showing the Maari acquisition. It was actually, it has an economic effective date of the 1st of January 2019. And so while we're still going through approval processes in New Zealand, and it hasn't closed yet, and so we're not counting the production barrels, because the effective date, the economic effective date was the beginning of 19, we do already get the economic benefit of those barrels that have been produced since then. And so whilst the headline cash consideration was 50 million at the time, actually by the time we close, if it is around the middle of this year, it's quite likely that we'll have received sufficient cash flow in the interim that not only will we get the asset, but the seller will also pay us some cash as well. It's the kind of asset that we like and that we look for because it has follow-on investment. These are big pools of oil with very low recovery factors. We have already identified some activity in what we call coil tube drilling, which will increase recovery and increase production. And there's a lot more that we can do. With very little activity, the fields will produce for another 10 years. As we work through our understanding and over the course of time, I expect that will extend very significantly beyond then. It's exactly the sort of asset that we look for because it does have significant capital investment potential to create more value. And then moving on to slide 8, which is the most recent acquisition, Peninsula, Malaysia. These are 4 producing fields we're acquiring from Sapura OMV, which is a local company, Sapura, partnering with the Austrian company OMV. We're adding again another 12.5 million barrels of reserves at a very, very low purchase price, modest consideration, and adding 6,000 barrels a day net to us, which is great. You can see a payback of less than 12 months, which is one of the better acquisitions we've made, and I would argue that really that opportunity and the quality of the opportunity is based on negotiating and agreeing the deal during the real low of the oil price cycle towards the middle and latter half of last year. Once again, we see a lot of investment to follow on post acquisition. The whole value story for what we do is what do you do with the asset after you buy it, and I expect we'll see a number of drilling campaigns in the years ahead, again to extend field life, add reserves, add value, and so on. And so we're really pleased with this acquisition. It's pretty important to get into Malaysia. It's a big hydrocarbon province. We have experience there from our past lives in other companies, and we're pretty excited about building out the business in Malaysia. And then finally, I just want to touch on undeveloped projects in the portfolio. And so, as I showed on the production slide earlier, we have strong short-term growth with drilling on the existing fields, closing Maari, closing the Malaysia deal. That will all give very strong growth into 2022 and 2023. And then beyond that, we have 2 undeveloped gas fields. One's in Vietnam called Nam Du U Minh. It's a legacy asset. We've been working with the Vietnamese on a gas sales agreement. It'll feed into an existing power station supply feedstock to a fertilizer plant that is used by all of the farmers in the Mekong Delta. So it has a really important local context. And there's very little, if any, alternative gas supply. And so we expect this project will move. It has gone slowly, and we certainly paused the project in 2020 during the height of the COVID impact, and now we've got to re-engage and get that going again. It's very exciting. It'll add a lot of reserves, production, and cash flow to the company. And then Lemang, which is in south central Sumatra in Indonesia, rather similarly, it's undeveloped gas, lots of markets close by, and again, we're just working on agreements to gas sales, and then we can move that project forward as well. And with a strong balance sheet and zero debt, these are both projects that we can fund without requiring any new equity. The tendency with these sorts of projects, because they're very secure, it's a state buyer essentially. These are fixed price, and so there's absolute certainty and zero risk around cash flow. And the contracts are for the whole life of field. So again, we're very comfortable that that you can have real certainty about the cash flow streams that come from them. It means that we can easily debt finance probably up to 2/3 of the project spend, just as we did with Montara. And again, with strong cash flows, relatively quick paybacks, it means that that debt can also be paid down relatively quickly. So these are great additions to midterm growth. Lemang will be around 5,000 barrels of oil equivalent net to us. The Vietnam project will be about double that. So pretty quickly, Jadestone gets to be 30 to 40,000 barrel a day business once these come on stream. So there's lots of positive in the portfolio now as we step forward, re-engage in growth, both short term and in the midterm. And so really just to conclude, as we think about our commitments and kind of what's on the top of our minds right now, of course, the day-to-day delivery of the current business and to do it safely is number one. Meeting our continuing targets of continuous improvement in ESG, in both environmental safety and governance targets. And I ought to say, from a governance perspective, as part of engaging more with UK best practice following our listing in London, we've adopted the QCA code of conduct and are filling out our sort of governance standards to be amongst the best amongst our peer group. Maintaining returns and liquidity, having become debt free, it does give us a lot of flexibility. We have significant capital available, as well as I said, to accessing debt. So we're in a very, very strong position to take advantage of opportunities as they come. And of course, we'd like to continue to grow. And whilst we offer now a dividend, and I think that's an important discipline to demonstrate to shareholders that you can return capital to them. It in no way is established to replace or get in the way of our ability to grow. And as a small company, growth is still what drives shareholder interest. It's certainly what drives my personal interest too. And so we sit in a very strong position with lots of organic growth within the business, and still looking to acquire more inorganic opportunities at a time when, frankly, if you think about the big picture, the majors are moving out of oil and gas. They all have a very heavy agenda into various forms of renewables, I think this accelerates the opportunity for smaller companies to step in, and we're pretty excited about doing that. So those are my those are my remarks based on the slide deck, and I'd just be so happy if there are any questions. Thank you.
Can you explain a bit more about your recent announcement on the capital reduction?
So as part of listing in London and pivoting towards London as a domicile, the company, and there's just history to this which predates me. It was listed and domiciled in Canada, and so we have we've established a top hat company, which is a UK PLC, which will replace the Canadian Topco. And in doing so, we're just simply transferring at value all Canadian shares to PLC shares. And the capital reduction program is just simply about quickly providing the capital to pay the second half of the dividend that we set up, but paying it through the PLC rather than the old Jadestone Inc. There's no implications beyond just that practicality. And of course, although there are several benefits, one of the key benefits which we haven't talked much about in listing in London is we remove the withholding tax, Canadian withholding tax, so that when we do pay the dividend, it comes 100% to the shareholder.
Okay. When you look at acquisitions, what do you aim to be your life of field cost per barrel, including taxes and ARO costs?
So there's really two different standards that we might apply. One would be to gas developments, gas fields, and the other to oil. And that's simply about about the product price, and what we focus on isn't necessarily the cost, it's more the margin. And so if I put that in context to try and answer your question, we would certainly look for operating cost base to be less than $20 a barrel, and what you call ARO, as if you like, the cost of decommissioning and abandonment at the end of field life. Generally on a discounted basis, we'd expect that to be less than $5. But it's a blend, because in Australia and New Zealand, for example, tax and royalty regimes, you do pay for that decommissioning at the end of field life. In most of Southeast Asia, in Malaysia, Vietnam, and Indonesia, in what's called the production sharing contract regime, PSC regime, the decommissioning is withdrawn on a unit of production basis through the life of field, and so it's is cost recoverable, and so it's a very efficient way of taking care of that cost, and it doesn't sit on the books as a result. So that's why to some extent we think about margin.
Okay, thank you.
Yeah.
We've got time for one more, Paul. Why do you think the stock is undervalued? What's your thoughts on that?
I think all of the oil and gas sector has been undervalued over the course, obviously, of the last 12 months, and whilst in the last 3 or 4 we've seen some recovery. And if I look at Jadestone versus peers, I don't think we are necessarily adrift of the sector. I think it's a sector thing more, and it's about confidence in the oil price as much as anything on the grander scale. My personal view is the industry has underinvested capital for the last 4 years, to the tune of almost $300 billion. I think we risk moving into a supply problem. And so, I'm quite a bull on prices, but nonetheless, we don't run our business on that basis. So I think the market has worried about oil price and recovery, and of course, as it turns out, I think it's recovered quicker and stronger than anybody imagined. All of the banks 3 months ago, all of the banks, were forecasting $50 to $55 for this year. We're sitting at 68 today. So I think that's, I think there's still more confidence in that oil price that will restore, I think value to stock across the sector.